The content of this podcast is provided for informational and educational purposes only and should not be construed as financial, investment, legal, or tax advice. The views and opinions expressed by the host and any guests are solely their own and do not reflect the views of any employer, firm, or affiliated institution. Any examples or strategies discussed are general in nature and may not be appropriate for your personal circumstances. Always consult a licensed financial advisor or other qualified professional before making any financial decisions. The host and production team assume no liability for any loss or damage resulting from reliance on the information provided in this podcast. How's it going, everybody? Welcome back to Trajecta Talks. I'm your host, Alex Savanovic. And for those of you who are new, I'm an experienced hedge fund trader, and this podcast is all about demystifying the world of finance for you, the next generation of leaders, innovators, and investors. I am so glad that you're here, and whether you're listening in your dorm room or on your way to class, or just trying to figure out what's next after high school, my goal is to equip you with the knowledge and confidence to build a solid financial foundation and make smarter money decisions. In past episodes, we've laid the groundwork on everything from basic financial instruments to the psychology of risk. Today, we're building on that foundation with a deep dive into an asset class that you interact with every single day, real estate. We're taking things to level 2 today. We did a level 1 before. We're going to go beyond the basics of just, home buying. We'll talk about a key metric called the capitalization rate, dive into the different types of real estate, look at how these properties are financed, and touch on some basic valuation methods for commercial properties. I even added a little bonus where we're going to discuss why the office market has been in such a state of flux recently. Now, before we get into this advanced discussion on real estate, our part 2 to the part 1 we released before, of course, we have to go over this week's market updates. Come on, I couldn't forget it. So first things first, let's look at some major corporate news, starting with Eli Lilly. Company stock rose after it released new data on its experimental weight loss pill. The trial data showed that the medication led to a significant percentage of weight loss in patients with type 2 diabetes. Now, stock ripped on the news. Following day, I tried to do the T+1 trade, didn't work out too well for the first few hours. This development in the drug intensifies the competition in the weight loss drug market with its rival Novo Nordisk. So ticker on that one's NVO, and I didn't say this for Lilly, but it's LLY. The pill's safety profile was consistent with injectable GLP-1 medicines, though it was slightly less effective at weight loss than the injectable versions. An oral medication is anticipated to be more popular with consumers and easier to distribute globally because it doesn't need to be shipped cold. Next, we're going to move right into the banks, specifically Canadian Bank, Royal Bank of Canada, beat analyst expectations with its stock rising 6% on the news. Its strong performance was a result of its capital markets business and higher net interest income. Switching pace from the market, on a different note, we saw some interesting comments from Commerce Secretary Howard Lutnick, who hinted that the federal government is considering taking equity stakes in American defense contractors. This idea has left investors in defense stocks contemplating the potential impacts. Lutnick noted that companies like LMT generate the vast majority of their revenue from the US government and are basically an arm of the US government. This concept has been met with skepticism by some analysts who question why the government would need to take a stake when these companies have excess capital and are buying back their own stock. So heading into the end of our market update segment, I want to talk a little bit about some trading dynamic stuff that I noticed just this morning, last night, we had the NVIDIA report gap down. Interesting to see that come all the way back unchanged on the open and rally the rest of the day. Very, very strong price action. Another one that really stuck out to me was MongoDB. Ticker there is MDB. Perfect, beautiful cup all morning, just sitting at that 299. I think started the day 295, gets to 299, gets to that big 300 figure, and then just breaks out all day. I think just before the market closed, I saw it 321 or something like that. But just like perfect price action all day yesterday following the report. You have Snow report this morning that gets a bid in the group. Just beautiful price action. Just some things to note that we don't typically cover in the market update piece that maybe you wouldn't see on Barron's or see on Wall Street Journal, but stuff that I'm noticing on the desk. So that's sort of all we have in terms of updates from the tape this week. Let's get on with the episode and talk real estate deep dive discussion today, part two. I'm super excited. I hope you are as well. So let's talk cap rate or capitalization rate. When evaluating a commercial real estate property, investors use a metric that's a lot like a stock's price to earnings ratio, but tailored for real estate. So the capitalization rate, or we're going to call it cap rate, it's a simple, powerful tool for comparing the income generating potential of different properties. So, in simple terms, the cap rate is the rate of return on a real estate investment property based on the income it's expected to generate. So, it sort of tells you, as a potential buyer, what your unlevered return would be if you bought the property with all cash. So, there's a piece in that formula for cap rate that's the net operating income, or NOI. That's the property's gross rental income minus all of the operating expenses. So, this includes things like property taxes, insurance, management fees, maintenance, but it does not include debt service, i.e., mortgage payments, or income taxes, or depreciation. So think of NOI as the property's raw before financing profit. So let's use a bit of an example to sort of illustrate it. You're looking at an apartment building for sale. It's $1 million. The building generates $100,000 in rental income per year, and the annual operating expenses, let's say 30,000. So first, you calculate the NOI. That's just 100,000, which is the gross income minus all the operating expenses, which we said was 30,000. So you have $70,000 of NOI, or net operating income. Next, you're going to plug that into the cap rate formula. So the cap rate's going to be 70,000 divided by a million, or 0.077%. So a 7% cap rate tells you that for this specific property, your potential annual unlevered return is 7% of your investment. So why is this sort of useful? A higher cap rate means higher return, but it can also signal higher risk. So a property in a less desirable neighborhood might have a higher cap rate to attract investors to compensate for the risk of lower occupancy or unstable rents. A property in a prime, stable location will likely have a lower cap rate because of its lower risk and higher demand. Investors can use the cap rate to quickly compare potential investment to similar properties in that area. So now let's talk a little bit about the nuances, because that's just one metric. A simple cap rate doesn't tell you everything. It'll never give you the whole picture. It's a snapshot. Doesn't account for future growth in income, or the age of the building, or potential rise in expenses. For example, a new building might have a lower cap rate because it has fewer maintenance expenses and a newer tenant base, so it's considered less risky. An older building in the same area might have a higher cap rate because it's a higher risk of needing significant capital expenditures down the line, but it offers a better immediate return. So the cap rate is a tool for initial screening. Like I said, quick snapshot, but you gotta always do a full financial analysis to understand a property's true potential. So move on a little bit. Switch speeds. Real estate isn't just about single family homes, obviously. Like we covered in the first episode on real estate, there are many different types of properties that make up this diverse asset class. First, we'll talk about residential real estate. This is what most people think of first. It includes single family homes, multifamily properties, duplexes, apartment buildings, things like that, condominiums. I know I'm sort of repeating myself here. We did kind of go through this already on the first real estate episode when we were covering the basics. The value here in these types of properties is driven by factors like location, school districts, general market supply and demand. That's a big one. Supply and demand in that market is sort of what dictates price. Now, moving on to commercial real estate, it's a tad bit different. This category includes properties used for business purposes, as the name suggests, commercial. The value here is sort of driven by the income that the property can generate from rent. So within this, there are several subcategories. First one that we're going to talk a bit more about later, office space. This is where buildings where companies conduct business, from towering skyscrapers in the financial district to suburban office parks. The value of these properties depends on the quality of the tenants, their financial stability, the length of the leases, and the overall demand for office space. So this market is heavily influenced by economic cycles, and as we'll discuss, major shifts in work culture, which was a big theme the last few years. Uh, Moving on from office, there's also retail, properties where goods and services are sold, ranging from small local shops to large shopping malls. The health of this sector depends on consumer spending and the ongoing competition from e-commerce. So a retail property's success is tied to foot traffic, visibility, the strength of its anchor tenants. Those are the big stores that attract customers. For example, if you've ever been to a wall with like a giant Walmart there, that's sort of like an anchor tenant. They're not going anywhere for a while. Next, we'll go on to industrial. This includes warehouses, manufacturing facilities, distribution centers. With the boom in online shopping and the need for faster delivery, this sector has obviously been growing very, very quickly. I won't dive into too much detail on some of the other ones. We discussed a lot of it in the first real estate episode. I just wanted to get our brains working again and sort of remind everyone what was included in this asset class. However, now that I think about it, one that maybe we didn't mention on the first episode was hospitality. So buildings that are hotels, motels, resorts, these assets are sensitive to tourism, business travel, economic conditions. Unlike other types, the tenants change daily, which means the income can be highly, highly volatile. The success of a hospitality property is heavily dependent, on management, location, broader economy. So shifting gears from types of properties, we're going to talk now about actually financing properties. So most real estate is financed using some form of debt, with the property itself serving as the collateral. So the most common type of loan for real estate is a mortgage. I'm sure you've heard of that. A mortgage is a long-term loan used to purchase a property where the property itself is pledged as security. If the borrower fails to make payments, the lender has the right to take possession of the property through a legal process called foreclosure. For a typical single-family home, financing is usually pretty straightforward. A person gets a loan from a bank, agrees to a fixed or variable interest rate, and pays it back over 15 to 30 years. For commercial properties, the process is a bit more complex. So these loans are often called commercial mortgages or commercial real estate loans. They are generally shorter term, often 5 to 10 years, and have different structures than residential mortgages. Also, in these situations, the lender's primary concern isn't just the borrower's like personal credit score or credit worthiness, whatever you want to call it. They're more focused on the property's ability to generate enough cash flow to cover the mortgage payments. So what a lender will do is they'll scrutinize the property's net operating income and the tenant's credit worthiness to assess the risk. So when looking at mortgages specifically, there are sort of two types that you've probably heard of: fixed rate and adjustable rate. So fixed rate mortgages, the interest rate remains constant for the entire term of the loan. This provides stability and predictability in monthly payments, making it a popular choice for homeowners who want to budget and are maybe concerned about rising interest rates. So, for example, a 30-year fixed rate mortgage means your monthly payment, principal and interest, will be the same the entire 3 decades. Adjustable rate mortgages, or ARMs for short, the interest rate is fixed for an initial period, 5, 7, or 10 years, and then it adjusts periodically based on a market index like the Secured Overnight Financing Rate, or SOFR. ARMs typically have a lower interest rate than fixed rate mortgages on the initial period, which can be attractive to buyers who plan to sell or refi before the rate adjusts. The downside is the uncertainty and risk of much higher payments later on if interest rates rise. So, how's a mortgage actually repaid? This part sort of confuses people. Most mortgages are amortized, which means the borrower makes a series of equal payments over the life of the loan. Early in the loan's life, a larger portion of each payment goes towards paying the interest, and a smaller portion goes towards paying down the principal. So, as the loan matures, this reverses, with a larger portion of each payment going towards the principal near the end of the life of the loan. Another important term is loan to value, or LTV. A key metric in both residential and commercial lending is this LTV. It's a risk assessment ratio used by lenders. Lenders typically want a lower LTV ratio, as it means the borrower has more equity in the property and is less likely to default. So, for example, a lender might only offer a mortgage up to 80% of the property's value, requiring the borrower to make a 20% down payment. So, moving away from LTV, Credit products, I wanted to discuss a little bit today. In our last episode, we briefly touched on a major derivative of real estate, which is the mortgage backed security or MBS. These securities are created by bundling together hundreds or even thousands of individual residential mortgages and selling the rights to the future cash flows to investors. So, an MBS is just a type of asset backed security or ABS that we discussed earlier. The bank that originated the mortgages sells them to a government sponsored enterprise like Fannie Mae or Freddie Mac, which then pools them and issues securities to investors. So when you buy an MBS or mortgage backed security, you're essentially buying a slice of all those homeowners' mortgage payments. And I know we covered this in the last episode, but just a quick refresher because we are doing a deeper dive on the real estate. So I feel like that ties in pretty nicely. And that also segues really perfectly into collateralized debt obligations or CDOs. So, a more complex derivative is the collateralized debt obligation, like I just said, or for short, a CDO, which is what I'm going to say going forward because the first word is just way too long. So, a CDO is a sophisticated structured finance product that can be backed by a pool of various loans, including MBS. So, the pool of assets is divided into different tranches or slices, each with a different level of risk and return. So, how do CDOs work? The riskiest tranche, called the equity tranche, gets the first slice of the income from the underlying loans. If some of the underlying mortgages default, the equity tranche is the first to suffer losses. Now, because of this high risk, it offers the highest potential return. And that's consistent with that idea of risk to reward ratio. Higher risk typically means higher reward. The next tranche up is the mezzanine tranche, which is slightly less risky than the equity tranche and offers a lower return. And finally, the safest tranche is at the top. That is the senior tranche, most protected from losses, but it offers the lowest return. So the reason I bring this up and the reason it's so important to understand, the CDOs played a central role in the 2008 financial crisis because they allowed financial institutions to take to take on enormous risk with very little transparency. They were designed to appear safe, but they were filled with risky subprime mortgages that were likely to default, causing the entire structure to collapse and leading to systemic risk throughout the financial system. It truly was fraud, deception, all the terrible things that you can imagine. So I don't mean to scare you by saying all that. Let's move on to a happier, more methodical topic. Let's talk about property valuation methods. When valuing a commercial property, a common method is the income capitalization approach, which is directly tied to our discussion on cap rates earlier. The basic idea is to take the property's net operating income and divide it by the market's prevailing cap rate to determine its value. So, for example, if you know a property generates NOI of 70 grand per year and similar properties in the market are trading at a 7% cap rate, you can estimate its value. 70 grand divided by 0.07, which is 7%, equals $1 million. So this method is the most commonly used for income producing commercial properties because it directly links a property's value to its ability to generate cash flow. That's not the only method, and in my opinion, it's sort of a very, very tunnel vision method. Another common approach is the sales comparison approach. So this is what is typically used for residential properties, but it can also be applied to commercial real estate, especially in areas with many similar properties. So in this method, a valuer would look at recent sales of comparable properties in the same or similar locations and adjust for differences in features, size, age, and condition to arrive at a value for the subject property. Now, this is a very common method for evaluating assets that don't have a reliable income stream like raw land. So while both methods are used, the income capitalization approach is often the primary method for commercial properties, obviously tied in with a bunch of other methodology, because it directly values the property based on what it is designed to do, which is produce income. Now, on that topic of producing income and commercial real estate and valuation, I felt like this discussion in this episode, Real Estate Part 2, was not going to be complete unless we briefly at least touched on COVID-19 and what happened to office space at that time. So As I'm sure you all can remember, the shift to remote and hybrid work has fundamentally changed the demand for office space. So many companies are downsizing their physical footprints, leading to a decrease in occupancy and, as a result, a decrease in the rental income or NOI for office buildings specifically. So when the NOI goes down, what happens to the property's value according to the formula that we talked about earlier? Value also goes down. So lower income means lower value, but it's a double whammy. As the risk of these assets goes up due to higher vacancies, investors also demand a higher return. So this means the market cap rate for office buildings has gone up. So a higher denominator, i.e., the cap rate, also drives down the calculated property value if you were to just look at that formula that we mentioned. So, this combination of falling income and rising perceived risk has created a significant challenge for the office real estate market, a challenge that is still playing out today in a lot of parts of the US and in Canada. So, this is a perfect example of how financial theory that we've discussed today, the relationship between NOI, cap rates, and values, plays out in the real world. I know it's never perfect, but this is why models in finance are so important, and not just in finance, but in economics as well. They help illustrate what goes on in the real world. Not perfectly, but helps us understand. So this level two, part two discussion on real estate, it's just the beginning. I really want to do a part three that dives a little bit deeper into some more complex topics, understanding how these sorts of properties are valued, how they're used by different market participants. The more layers you peel back, the more opportunities you'll uncover, and the more prepared you'll be to make informed decisions in your real estate career if you decide to have one. So remember, the financial markets are a continuous learning environment. The concepts that we've discussed today, from the importance of the cap rate and the diversity of real estate assets to the mechanics of financing and basic valuation, they're all crucial steps in building your expertise. Even if you don't go on to be a realtor or a broker of some kind, these are still really great things to know. It's a super dense topic. I feel like even though we're on part one and two in the books, we've only scratched the surface. We'll definitely be back with a part three to dive even deeper, like I said. So now, really quick before we finish off the episode, I want to talk about some stock picks. We did have a new one. I wanted to go over the one from last week and the new one. So last week's submission, if you guys remember, we had a listener go short Palo Alto Networks. That ticker symbol is PANW with an entry price of 184 and a half. I said it on that episode, brave call. And as it happened right on the heels of a much better than expected earnings report. And as we can see, the market has not been kind to that short position. The stock is, unfortunately, for our anonymous listener, currently trading around 3 points higher than that entry price. So it's something I noticed following that Palo Alto report. Obviously, it was strong, but it's very possible and plausible to me that the strength that we're seeing in cybersecurity and software, from reports like Snowflake, MongoDB that I mentioned earlier, being so strong, it's also sending some lift to PANW via ETF. There's just a bid in the space, it feels like, in that rotation out of AI into software. It's just a good example, I think, of how a single company's good news can ripple out, create strength across an entire industry. I feel like that's what we're seeing play out a little bit. So we'll be keeping an eye on this one. We'll check back in next week to see if there's any improvement in that position. But anonymous listener, if I was in your shoes, that might be a stop out for me at this point, just given the strength in the space. So for this week's new submission, we had a listener send in a pick for a long position on AS. That's a relatively recent IPO, Amber Sports. I think that's the company that owns Arc'teryx, the jackets. This one is particularly interesting because our listener sent it on the same day that there was a huge secondary block trade. So I need to be clear here. This wasn't the company issuing new stock. I'm pretty sure this was a selling shareholder. I might be wrong, but I'm pretty sure that's what it was, offloading a very large block of shares. I think Morgan Stanley priced the block at 39.9, and our listener's suggestion was to purchase the stock at a price of approximately $40. This is a classic contrarian move, buying into a stock when there's a huge supply coming into the market. The thinking is that, maybe this large block of shares creates a temporary overhang that can weigh down the price. But once that supply is absorbed by the market, the stock can be free to move higher. So, it's a bold play, and we love to see it. just like with our friend who was short Palo Alto, PANW, we'll track this one as well. Comment on the performance next week, and we'll definitely provide an update on how everyone's doing. So that's all we have on stock picks. To both of our anonymous listeners, nobody likes to submit their name anymore. Best of luck to everyone. If you feel like you can pick a winner, please hit me on any of the socials and let me know your picks. I can't wait to go over them with you on the next episode. So that is all the time that we have for today. Thank you so much for joining me on Trajecta Talks. I hope that this Level 2, Part 2 discussion on real estate has given you a clearer, more nuanced understanding of this vital asset class. So remember, like I always say, the journey to financial freedom begins with a single step, and that step is knowledge without a doubt. And if you want to continue your learning journey, to stay connected, be sure to follow us and our sponsor, Trajecta University. That's Trajecta University. You can find us on Instagram, LinkedIn, Facebook by searching for Trajecta University. And also check out our YouTube channel at Trajecta Talks, where you can watch this episode and find a ton of other great content. All the links for all of our socials and the YouTube are in the show notes down below if you want to go and check those out. So that's all we have. Join me next Friday for another episode and a bit of a surprise too. I think you guys will like. Stay tuned for that. Until next time, hope everybody has a great long Labor Day weekend. There's no work on Monday. Markets are closed. Take care. So have a happy Friday, everybody, and I'll see you on the next episode.